Hello, everyone. I'm Kevin McCaffrey for Private Markets Insider, and I'm fortunate to be here with Tom Tull. It claims to be a former retired Chief Investment Officer for Employee Retirement System of Texas, but I shudder to think that you're retired because you seem to be quite active member of the Board of Trustees in the Dallas Police and Fire Retirement System, as well as other boards. You've been kind enough to be part of the Insider Advisory Committee for Private Markets Insider, among other advisory roles. I think you're on the road more than I am as we meet here in Atlanta. Thank you for joining us. We're here for the Alternative Investment and Deal Connect Summit. You'll be speaking on secondaries a bit, but more broadly speaking, you've seen the evolution of private markets during your career. And I just wonder, have you seen that it's justified, all the flood of capital coming into private equity and private credit increasingly in terms of the returns versus the lack of liquidity? Has it been justified?
First of all, it's a pleasure to be here, and retirement is great. This is my third retirement. So bottom line, the answer is yes. And it comes down to competitive, risk-adjusted rates of return. And I think it's going to continue to get more mileage, more momentum as we go forward, because it is a very inefficient space in the overall market. Returns are tremendous, anywhere from 200 or 300 basis points over and above what you can get in the conventional markets. And you're not taking on that much more additional risk at the end of the day. So, no, I think it's definitely going to become a mainstream as we go forward. It will continue to evolve, and we can go into the reasons why. I think this is, the best thing since sliced bread. But with that, I definitely believe it's a keeper as we go forward.
Well, sliced bread was a keeper, so we'll see. But even evolving beyond just private equity and private credit, we've seen secondaries really expand, and private equity, and in particular now, private credit has become a focus. And I wonder, how are you viewing the secondaries market, and what are the primary reasons that it's grown as much as it has?
Well, I think it's a good question. I think it's going to continue to evolve and develop. And at some point, there will be new flavors as we go forward in terms of what is a secondary and terms of credit and private equity. Credit now is a space that's getting a lot of attention in the marketplace, and rightfully so. It's inefficient in terms of pricing. We're having some banking issues out there, which have also accelerated the process. But bottom line, the primary reasons in looking at really the alternatives and specifically secondaries are: one, great diversification. Two, it's an opportunity in the marketplace to take advantage of dislocations in that marketplace. We all know there's a lot of volatility going on, whatever the cause, whether it's geopolitical or U.S., but that brings with it an opportunity to invest and get competitive risk-adjusted rates of return. And then finally, other than being opportunistic, it provides, bottom line, good rates of return, and you get the benefit of the J curve as well.
And do you feel that diversification is also a big part of the driver?
Absolutely. The more diversified, they say on Wall Street, the only free lunch is a diversified portfolio. So it's a process that you're always looking for good diversification. You don't want to have everything in one area. And at the same time, it gives you the flexibility to go in and out of different asset classes based on where you see the best opportunity at a point in time.
Great. Well, appreciate having the insider's view on private markets here, and thank you very much for joining.
My pleasure. Thanks again.
Cheers.
Great to be here.